Well, hello, everyone. We're going to go ahead and get started. Uh, the purpose of today's webinar is to discuss the current investment climate. And, every so often there's a significant change to the investment climate. And we thought, holding a webinar to go over some of the readings that we're seeing would be of value to you. These significant changes occur from time to time, and usually they take people by surprise. We've been seeing evidence of this developing really over the last year or so. I think we certainly could all agree that the investment climate is significantly different recently in the last 6 to 12 months than it has been for a number of years prior to that. So in today's webinar, we're going to kind of mix the current market conditions along with an overall proactive investment approach in terms of how we use different tools and models to identify market trends, potential turning points, and risk levels, as well as opportunity in the market overall. So just a couple of housekeeping items up front. There are a few pieces of information, materials available that are available for download in the chat. So you could access the chat at the bottom of your Zoom window. There should be a chat icon, and there's just a number of things there that you may find of some additional value either during the webinar or after the webinar. You could also ask a question using that same chat feature. So if you have a question during the webinar, type it in the chat. At the end of the session, we're going to address questions. And if it's something that we believe would be of value to the group, we'll address the question. If it's more of an individual question or to a specific situation, we think that's best addressed with responding in an email after the webinar or a phone call after the webinar. At the end of the webinar, we are going to offer everybody a complimentary second opinion on their investments. So if you think that you're not sure if you're positioned the right way, if you're receiving the right advice, then that will be a complimentary offer that you could request at the end of the webinar. So with that being said, I'd like to ask for a little bit of your participation to start off with. Why are you attending this seminar? Right, so we're going to put up a poll and give you a minute or two to answer. You could answer select more than one answer if you want. So I'm concerned the Federal Reserve inflated a bubble. I'm concerned about the social and political environment. I'm unsure if I'm receiving financial advice that I need to accomplish my goals. I thought I knew what I was doing, but now I'm not so sure. We'll see how many people are honest. Okay, well, hopefully everybody's had a chance to choose, and the leader is, I'm concerned the Fed is inflating a bubble, and that was followed by, I'm concerned about the social and political environment. Thanks for participating. It's always good for us to, understand a little bit about what's on your minds. And certainly we talk to our clients and have a good understanding of what's on their minds. And I think they probably share those same concerns that you do about the Fed and its actions, as well as the social and political environment. And we probably could add the economic environment to the mix as well. Okay, I'm going to start sharing my screen. All right, so let's talk a little bit about the flaws of a buy and hold strategy and why do we want to attempt to identify market trends and be more proactive with investments versus, let's face it, what's much more common and much more popular these days is to kind of be more passive and diversified and then ride out market fluctuations. Well, if we look at this chart that we're showing, the result of writing out every market downturn may not be acceptable when you're looking at your goals, your circumstances, your objectives. A lot of these studies that prove that just writing out market downturns and, staying the course are done over exceedingly long time horizons. And, that may not necessarily align with your specific time horizons. The long-term market history shows that lengthy periods of advances are followed by lengthy periods of declines and then recoveries, right? So passive investors who write out every market downturn, according to this chart, as you can see here, only built new wealth about 46% of the time. And this goes all the way back 72 years. So said differently, more than half of the time, you're writing down a bear market that's noted by the red part of this chart. Those are declines of 20% or more from the high. And then the blue part of the chart is the recovery from the previous bear market. The green part is building new wealth. Now, what makes this even more, I think, important to understand is that these bear markets and significant downturns are rarely isolated occurrences, right? And so we could see in 2000, we had a considerable decline and a recovery, only to be followed by yet another decline and recovery. And if we go back to this period here, you could see multiple declines and recoveries. So, these decades or longer periods are kind of clustered together with bear markets and recoveries. If we enter one of those types of prolonged periods of decline followed by recovery and maybe another decline or 2 or 3 times that could happen, it could be many, many years before a passive investor finally recovers, their previous high water mark. Of course, that becomes more and more important as you get a bit older, a bit closer to retirement or further into retirement. But for anybody, even, younger investors, losing a decade or longer is not a pleasant experience. And of course, people often tend to become more emotional at that point as well. And, that could cause them to make, decisions that are not appropriate to their overall financial situation. So that's why we believe it's important to identify these significant market downturns. Now, you don't have to identify every market downturn. It's only the major ones, right? And that's what we're after. If we look at the long-term market history in this context, which adjusts the S&P 500 index for inflation, those recoveries could take even longer. Let's go back to the 1960s to the 1980s, 1970s, 80s, 90s. Really, that peak that we showed right here, which looks like it took maybe 15 years or so for the market to really start making new progress from the late 60s to the early 80s. When you adjust it for inflation, it really wasn't until the mid 90s did inflation adjusted portfolios start making new real progress. So that's a 30-year time span. So yeah, we absolutely believe it's important for investors to have a component of their investment strategy that aims to preserve wealth during significant market downturns. This next chart is going to show that simple math. Bigger losses require greater gains to get back to even. So if you look at, these types of declines in here, the 10, 15, 20% declines, those could happen quick, and the recoveries, 10 to 25% or so to get back to the previous level can also happen very quickly. But once you start getting into these levels of declines, the 35, 40, down to 50% declines, those are the ones where your portfolio could take a serious blow, because obviously not only does that get more psychologically damaging as you see that type of loss, but the recovery is so much longer, and the market needs to recover so much more lost ground just to get back to break even, right? So when we look at identifying market trends and trying to avoid significant market declines, we're not so concerned with these smaller ones, because we know those can happen quickly, can recover just as fast as they occur. It's these larger ones that we look to sidestep for our client group. Right now, if we go back to this chart here, in 2000, there was a 50+% decline. And then starting again in 07, there was another 50+% decline. So that required two 100% advances in the S&P to get back to the previous highs. And that's why we had this, 13-year period where there was no progress made for passive investors just buying and holding an S&P 500 index type of fund. Okay. So preserving wealth during these massive bear markets is crucial, we believe, to achieving financial independence, and wealth preservation is a core part of our investment philosophy. I mean, another way to think about a bear market is the time it takes to recover. This shows, of course, depending on your rate of return during the recovery, it could extend out several years, or you could recover faster. So a 40% drop in the market, which we know could probably take a year or two to work itself out, then could take another 5 years to recover if you're getting 11% annually, right? But if you're getting 3% annually, it takes 18 years. The reason we point this out is that after big drops, a lot of investors just get shell-shocked and they change their approach to one that's more conservative. And then that makes the recovery even more extended, right? If we're able to avoid a large part of the 40% decline, it's not as psychologically damaging. Therefore, you can, it's easier for investors to maintain a positive outlook and be able to recover faster and be in that wealth building mode more than a purely passive investor. Okay. So Arlington Wealth Management aligned our investment management approach with the number one concern of our clients, and that is preserve their wealth. We built a quantitative model to help understand potential risk levels and market trends, economic cycles, and possible turning points in the market. We believe there's times when it's appropriate to shift from wealth accumulation to preservation. At times we scale back risk, and we really started doing that a year plus ago in 2021. At other times we look to eliminate it. We started doing that about 3 months ago. And, really that type of adjustment to the risk is carried out through all of our investment strategies, even our most aggressive growth strategies. So all of our investment strategies incorporate this overriding risk management philosophy. So we use a few different tools. There's a market model that we use. There's a recession warning model and a market valuation model. And those are the tools that we use to help manage accounts and portfolios, and execute proactive strategies. Our market model is designed to identify prevailing market cycles. Are we in a bull market or bear market? The recession warning model is designed to alert us to potential recession. And the market valuation model helps us understand the very long-term potential of stock prices. We're looking at 8, 10, 12-year type of returns in the market with our valuation model. Now, I want to be clear that we use these models to preserve wealth for our clients when it's appropriate, and that's the top concern amongst our clients. However, they also desire to accumulate wealth, to achieve their goals, enhance their lifestyle, provide for long-term needs, prepare for the unexpected, etc. So when our market and recession warning models are positive, which is the vast majority of the time, our focus is on wealth accumulation to achieve their life goals. But there are critical times, like what I believe we're in currently, when switching that focus away from accumulating to preserving is the priority. So let's go in and talk a bit about our market valuation model, our market model, not valuation model, but our market model. And so that's designed to identify the primary market cycle and potential turning points, right? The objective here is to position your portfolio for wealth accumulation when the models is positive, but then to change the focus to wealth preservation when the model's negative. It's important to note the model is positive 85% of the time, which means we focus on wealth accumulation the vast majority of the time. The approximate 15% when the model is negative, that provides us a sell discipline. And we believe that's a critical element in a proactive approach designed to preserve wealth for our clients. This model uses a set of proprietary indicators, right? And we're going to get into a little bit of those indicators in a minute. It's important to note that we developed all of these indicators over many years through extensive research. They're proprietary to us. Each indicator is independently designed to identify market trends. However, we don't rely on one indicator alone for the cycle analysis. It uses indicators as a set, requiring confirmation of each indicator's indications, right? So let's go in to talk about a couple of these proprietary indicators. The first one we're going to look at is our cash comparison charts. And our cash comparison chart is recorded in what we call a point and figure style to help us understand if we should expect a higher rate of return owning stocks or holding cash. Okay, so there's a lot of complexity behind the calculation of the chart. We won't get into that. But very simply, once it's calculated, the interpretation is rather simple. When the chart is trending higher, global stocks are providing better returns than holding cash, meaning it pays to take risk owning stocks. When the chart is trending lower, then cash offers a better return. So the safety of holding cash is better than the risk in stocks during those times. Okay. And this is up to date, so you could see a little bit of action up here at the top. What looks a little suspicious compared to these uptrending patterns, right? The most valuable use of this chart is identifying the turning point in the market cycle, right? So what I'm going to do here is zoom in to get a closer look at the change in the market cycles in the year 2000 and 2008. The cycle changed from advancing to declining during both of these times. And that indicated stocks were beginning to lose ground. When the trend changes like this from positive to negative, It's one of the tools that we use to know when to move to preserve your wealth, sell stocks, and move to the safety of cash. Now, if we look back to, and I keep these time frames in mind, 2000, you can see the year timeline down here. 2007, 2008 was the other change, right? Let's go back to look at this chart. And, what we see here is this period right here, right? So in 2000 and 2007, 8, note these two significant bear markets where, a buy and hold investor lost significant wealth during those two bear markets. And additionally, it took them a long time to recover that wealth, right? So if you rolled the whole period out, it was from 2000 to 2013 before you started making new wealth during that time. And of course, if we adjust it for inflation, it's going to be even longer that your purchasing power recovers. So that's really the big use, the important use of this particular indicator. In addition to help deciding when to preserve wealth, if we can minimize the time spent losing wealth, then the required time to recover is shorter, and we could potentially spend more time creating new wealth than a strategy that passively rides out bear cycles, right? So, bring up this chart. If we're able to cut those losses short and preserve wealth during the bear markets, then we could get back to wealth building mode very early in the next bull market, as opposed to the investor that rides out the big declines and could take many years to start building new wealth again. So that's one of our indicators. Another of our proprietary indicators is called the long-term momentum indicator. This uses month-end closing levels of the MSCI All Country World Index. We take different or various momentum calculations to help determine the market's very long-term momentum. So we consider the status positive when all of the calculations are positive, and that's noted by the green shading on the chart. When all are negative, it's noted by the red shading on the chart. And when there's conflicting calculations, some positive, some negative, we have the white shading, and that's a neutral status on the chart. This indicator, we believe, is invaluable in helping us identify primary bear cycles. Once again, I want to point you to the change in the momentum at these key times in 2000, in 2008, relatively early in those bear cycles. It being a momentum indicator, it's not designed to try to pick the top. It's designed to try to understand when that long-term momentum is changing, to help us take proactive approach to managing risk. So if we look at, again, 2000, 2008, and so we're right here, 2000, 2008, when you have indicators like the cash comparison chart and the long-term momentum indicator, it can increase your probabilities of being able to identify the bear cycles. And, that's really it's really the argument for passive investors is nobody knows when these cycles are coming upon us. And then when do you know when to get back in? So you might as well just write it out. We disagree with that. We think that, anybody who says they don't know when these cycles are likely developing hasn't taken the time to try to, make an effort to learn how to identify these cycles, right? We've spent a huge amount of time and resources over many years studying the market, developing these strategies and indicators, and we believe it does give us an edge to identify these important market trends. Now, when these indicators, as you could see, right, let's go back to current time now. You could see the long-term momentum turn negative. It did that in January. You could see prior to that, it changed from the positive to the neutral. That's a typical progression, during a bear market, positive, 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 neutral, negative. Same thing tends to happen during these periods. And when we go back to the cash comparison chart, it's a little smaller. I wanted to give you the full history of it to get the full picture. But, you could see a potential pattern that's somewhat similar as these patterns up here. So that tells us the odds of a bear market are upon us. And that's when we want to take proactive action to, move to preserve client wealth. We kind of call our proprietary indicators our tornado warning system. When the siren goes off, we head to shelter, ride out the storm. The storm may pass quickly, and if so, the indicator sounding all clear, because the opposite side of what we're looking at right now, these indicators firm up. They show a better potential in the market. That's the all's clear signal. However, if the storm hits, the tornado hits, we're protected. And of course, then what's the category of the tornado? Is it going to be a Cat 1 or is it going to be a Cat 5? In either case, we want to be in shelter and protected during those times. Our market model develops rules-based signals that using the indicators that I described here and others as well. You don't want to go into excruciating detail on all the different indicators we're using, but just to at least give you a flavor of the types of tools that we use to make decisions and are available. So these signals that the model develops, they're based on rules that we've refined over many years. And there are a few important ones. The first is called the global sell signal. And that is our sell discipline, our tornado warning. We change asset allocations to preserve your wealth when a global sell signal happens. Now, depending on what's happening in the economy and economic conditions and risk levels and so forth, we may invest in certain asset classes, safe haven asset classes, for example, or even hold hedge positions designed to appreciate during equity bear markets. But the number one goal and principle is to preserve wealth, move to preserve wealth during the global sell signal. Then there's a global buy signal, which really is just the exact opposite of the sell signal. And that serves as our all's clear warning, indicating the bear market is likely over. A buy signal can occur relatively quick after a short bear cycle or years later following an extensive bear cycle. So when we get the buy signal, though, whenever that happens, our investment team changes asset allocations with an aim to create new wealth for you following those buy signals. So we move out of the safe haven cash type of investments and into growth assets. And the specific growth assets will depend on the specific strategies that are being used in your portfolio. And all those strategies are, further information described in detail in the investment management approach document that is attached in the chat room, I guess you could call it, which is available for you to download. There are also tactical signals, and those occur when market conditions become extreme. For example, equities will periodically rise to unsustainable levels during bull cycles. That's what happened last year, according to our model, and there was a tactical sell signal. During that time, the tactical sell signals help us pare back market exposure, right, until those high risk conditions work themselves out. And then there's tactical buy signals that identify low risk market conditions, and that often provides an opportunity to invest new funds. So we use the market valuation model as a primary tool to identify the market trend and the potential turning points. Now I want to move on to talk about our next model, and that's the recession warning model. This is designed to give us an advance warning of an economic recession. Historically, equity markets will peak several months before a recession starts. So having an advanced warning system helps us make proactive decisions, gives us another tool in our ongoing effort to preserve client wealth. The recession warning model uses 10 different economic statistics considered to be leading economic indicators. We include data from various economic sectors, things like housing, money supply, interest rates, employment, and inflation. Historically, bear markets in equities coupled with a recession tend to be more severe. The declines are more extensive and they last longer. On the flip side, when there's a bear market, but there's no recession, tends to be less extreme with smaller drops and shorter recovery periods. So due to the severity of market declines during recessionary periods, that's why we built the economic model. It could take a long time to recover from a recession-driven bear market. This is a visual that I think helps prove the point that economic recessions really affect equity bear markets much more significantly. It shows the price decline and length of all corrections in the S&P since 1965. That's a drop of 10% or more. The blue points, blue diamonds on here, show all corrections in the S&P without a recession. And the red diamonds are all corrections or bear markets with a recession. So what we could see is the average correction without a recession is a 15% drop in the S&P, but with a recession, it's 36%. So much more severe decline. The other takeaway is the time. Here's the timeline on the bottom axis. And what we could see is without a recession, the average decline only lasts about 100 business days. That's about 5 months. With a recession, it's 3 times as long. It's about 1.5 years from high to low. And you can see many of those recession-driven bear markets are even longer and more severe than the average. Now, if we go back and look at this chart, right, a 15% correction, if we have a decline without a bear market, you know, that's an easy one to recover. But if we have a decline with a recession, much more difficult, much longer, and requires a bigger recovery in the market to reach the previous high. So, you know, these recessions are damaging to the market overall. And that's why we developed a recession warning model. Now, why do we have a model? We have the government, right? The government tells us when we're in a recession. Can't we just use them? Well, no, we can't, because they're a day late and a dollar short. For example, it was December of 2008 that the government announced that the U.S. economy had entered into a recession a year earlier, in December of 2007. The S&P peaked 14 months earlier than when the government told us that we were in a recession. It had already dropped 40% by the time they declared a recession. So we need some sort of modeling that has predictive warning capabilities, right? Let's zoom in on the recession warning model to once again study the 2 really critical periods in, let's say, the last 25 years, right? I mean, if we really look at it, the only significant bear markets that, you know, lasted any degree of time was in 2000 and then again in 2008. So you could see that the recession warning model That occurs when it drops below the zero line. So in fact, that occurred in 2006, over here, I'm sorry, 2006, 2007, and then again in 2000. So that's a good length, warning period before the recession actually hit. And again, we don't have to, keep revisiting these, but those were both the 50% declines that we saw. And it's these cycles that we aim to sidestep to preserve wealth. Now, when we have two different models, how do we use these two models and combine their use, since each model is independent of each other and completely using different data, right? One's using market information, the other's using economic information. The market model is more active than the recession model. It tends to develop global sell signals more often than we get recession warnings. So when we get the market model to give us the sell signal, we respect the market model. We move to preserve wealth during that time. Without a recession warning, that could still happen later, by the way, but usually the recession warning would happen first in those cases. But without a recession warning, we expect a relatively minor bear market, one that's shorter and less severe than the recessionary driven bear markets, right? But we know from going through them that even minor bear cycles can be unsettling experiences. The news cycle turns very negative, pessimistic. It causes investors to become emotional and make irrational decisions. So preserving wealth during those times, even if they're shorter periods, provides peace of mind. And there's something to be said for that. So when we get a sell signal in our market model without a warning from the recession side, we design one of our tactical buy signals to help us determine a low risk, high reward time to begin to re-enter the market when much of the risk has been removed. And but be clear, that approach is only used when there's no warning from our recession model. Of course, when both models are negative, we move to maximum wealth preservation mode. We wait for the market model to develop a global buy signal before moving back into wealth accumulation mode. We don't use or we minimize the use of tactical strategies when there's a recession warning, because we know those bear markets can be more severe when they're coupled with a recession, and could take a long time to work themselves out. The last model I want to cover today is our market valuation model. The market valuation model is used differently, where the market model and the recession warning models are really valuable tools for making ongoing proactive investment decisions. They help us understand the current market and economic dynamics to know how to position your portfolio to be in alignment with those cycles. But what about understanding the potential opportunity or lack of opportunity in the market over longer periods? For example, why does the market boom for lengthy periods without any significant bear markets, but then struggle over other lengthy periods? Right? Why does this happen? Why in this 13-year period were there two huge bear markets and no progress made? And why did this happen in the 1960s, 70s, and early 80s? But after that period, there were almost no bear markets. There was one short one here. And really the COVID drop was the only one that was more than 20% during this recovery. We believe that the answer to that question lies in what the current valuation for equities is. So what we see is when market values are high, when bear markets start, then there's a bigger potential that we've entered one of those longer, what we call secular bear cycles, which could, have many bear markets within, some lengthy period of time, 10, 15-year period. And that causes that lost decade type of environment. But when market valuations are low and there are, sell signals in our market model, for example, those tend to be very short-lived bear markets. So when we look at the current position of our market valuation model, which, by the way, the model itself uses 4 different indicators, which in themselves are have high correlation to be able to predict long-term stock returns. So this is a 60+ year look back of this market valuation model. The blue line is the valuation model itself. Okay. And then the shaded area, the blue shaded area, is what happened in the next 10 years in the S&P 500. So high valuation models produce low forward returns, right? Let's look at the year 2000, which was the second highest reading. Okay. Only surpassed recently. And we see that the next 10-year return was low, or actually negative, in the S&P following that high valuation model. And when valuations are low, like they were here in 2009, the next 10 years are strong in the valuation model, or I should say for the S&P 500. You could see there a 250% gain if you bought the S&P, near the low in valuations. And back here in the 1980s, when really for a long time, valuations were extremely low. Look how great returns were in the future. Well, where we were prior to this decline, and you could see a little bit of decline bringing valuations down, but they're still lofty, leads us to believe that the probabilities that we are entering one of these secular bear cycles is higher than, certainly higher than when the valuations were low. So in our view, it's no coincidence that, we started one of these secular bear cycles in 2000 when valuations were high. Now, nobody knows where the highs are in these valuations as they're riding up. It's very possible that wasn't the high for this cycle. But once they turn, you can see it could take a long time for valuations, and the pendulum swings back in the other direction over many, many years. So we find this model helpful in making very long-term forecasts, but not really for the short, intermediate term decisions. High and low valuations can remain extreme for a long time before the market adjusts. But when we see markets adjusting from extreme valuations, whether it's a change in the potential cycle from, up to down from high valuations, we know that risk is higher. When it's a change from a down cycle to an up cycle in the market from low valuations, we know that could potentially lead to a multi-year market opportunity. And we're not there right now. So we have to, we have to understand that market valuations can come down over time. That doesn't mean there won't be opportunities in the market, but it could be, equally important to preserve wealth in the next 10, 12 years as it is to accumulate wealth, right? So I would say an investment approach that is dynamic and doesn't just look at it one-sided, that we should always be looking to make money, I think we'll have a better chance of succeeding if we do enter one of these long, prolonged bear market periods. I'm going to move on to talk a little bit about our investment strategies. Arlington Wealth Management uses several strategies with objectives ranging from producing reliable cash flow, right, on the one side, to creating new wealth on the aggressive extreme. But at the core behind each strategy is our own research database, custom software that we've built, all to help us understand market tendencies better. We've conducted more than 6,000 market tests and research studies over many years. And the results of that research and study, that serves as our knowledge base to help us make intelligent, informed investment decisions. For many clients, we combine several strategies to accommodate their objectives and needs, in their overall portfolio. So when we recommend strategies, we're designing it to be risk appropriate for every account in a family's portfolio, based on what that account's purpose is in helping you achieve the outcomes that you seek, right? You could learn more about our investment planning process. We're happy to send, a document to you that explains our investment planning process. Just request it, and we're happy to send that out to you, right? But accounts that clients are maybe depending on for lifestyle, we're using strategies designed to produce reliable cash flow and lower risk, right? For accounts that have a longer investment horizon to grow for the future, prepare for the unexpected, or pass wealth on to your heirs, or just be there for your use later in life, we have higher growth strategies. And of course, we want to make those risk appropriate for the needs of each account. Our approach to investment management is top down. So first we start with the big picture and then working down into decisions on specific transactions. We analyze the overall market and economy first. And that's why we started with showing you our market model, recession warning, market valuation model. That's our way of analyzing the overall market and economy. Then we go into asset class selection and then individual security selection. And then each strategy and asset selection methodology will really be dependent on, the specific strategy that is being used for a client's portfolio. But I want you to keep in mind, all strategies will move to preserve wealth using our market and recession warning models when they're giving us the warning that we should do so. Our flagship strategy, many of you have probably heard of PAS, that stands for Proactive Asset Allocation Strategy. That's our flagship strategy. We manage an exchange traded fund, or ETF version of that strategy, and an individual stock version. We call that the PAS ETF and PAS stock strategies. So what I'd like to do, just to give you a flavor for how we approach managing these strategies and selecting assets, let's first start with how we select asset classes, because it's the same for both strategies. Then we'll explain our process for selecting the ETFs and the stocks in each strategy. Our approach to investing rejects a couple of mainstream theories. One is that you should always stay invested in the market and ride out market downtrends. And, we've shown you why in this webinar. The second is that more diversification always leads to better results. Our research shows that adding more asset classes to your portfolio, only because they're different from the other asset classes you own, does not lead to better risk-adjusted returns. So in other words, the benefits of diversifications diminish at a certain point, and over diversification is as counterproductive as under diversification can be. So I'm going to show you our asset class ranking system. Now, keep in mind, this is going back a couple of years in time, so it's not the current ranking, but we developed an asset class ranking system to help us isolate the potential leading asset classes in any particular market cycle. Asset class leadership varies from cycle to cycle, right? Based on a lot of different variables, financial and economic variables. In specific cycles, for example, just very simply, growth stocks focusing on technology and disruptive industries can lead. But in other cycles, value stocks and economically sensitive sectors are the leaders. So this system that we design ranks hundreds of different asset classes, industry groups, foreign markets, commodities, and investment themes are all part of the ranking system, and we rank them using a proprietary formula. We design the algorithm to identify asset classes that exhibit specific leadership characteristics. So in short, it helps us separate the stronger and weaker groups so we could focus on the potential leaders. Based on extensive research, we have good reason to believe that asset classes exhibiting leadership characteristics at the time of our market model's buy signals are likely to lead to the market forward in that particular cycle. They're likely to be leaders in that upcoming cycle. A select list of asset classes that have been leaders in various market cycles in recent years include automobiles, home building, semiconductors, online retail, solar energy, and biotechnology. But as I said earlier, we also believe diversification diminishes after a certain point. So we strive for focused diversification, to be diversified, but focused in potentially stronger asset classes. And equally important, we aim to reduce or eliminate your exposure to the weaker or vulnerable groups. Depending on market conditions, we may diversify in more asset classes or focus on fewer asset classes at the time of a buy signal in our model. So this is a screenshot of our asset class ranking system, which showed the leading asset classes at the time of a buy signal in our model on June 5th, 2020. Okay, so you could see the ones that are highlighted in green are the ones that our algorithms are selecting as the potential leading groups for that upcoming bull cycle that followed at that point. So think about that as coming off of the COVID drop in the market. That June 5th was the time when our model gave a signal, and these are the asset classes selected at that time. So the top-down approach works like this. First, our market valuation model helps us understand if conditions are favorable for wealth creation with a buy signal. Then our asset class ranking system allows us to choose the potentially leading asset classes for that particular cycle. The next step is to select specific securities for your portfolio in the desired asset classes. And we manage an exchange traded fund and an individual stock version of PAS. So in the exchange traded fund version, we're going to choose funds that give you exposure to these potentially leading asset classes in any particular market cycle. So on that June 5th date, which is the start of this chart, you could see these are the asset classes, or at least some of them that we were looking at earlier, ones that are available for charting formats like this. And you could see the number of months following into the early part of the next year, the return of those four asset classes there. So what we would do in our PAS ETF strategy is choose an ETF that gives exposure to the auto sector, one that gives exposure to online retail, semiconductors, et cetera. The PAS stock strategy takes the security selection one step further, whereas the ETF strategy will own funds consisting of baskets of stocks in these asset classes. The stock strategy focuses on potentially strong stocks in these sectors, right? So we expect the asset classes to be leaders in this economic and market cycle. However, specific companies are going to lead others. So the stock strategy strives to own stocks that are leading the charge in autos, online retail, semiconductor, et cetera. The way that we choose those stocks is we rank the individual companies owned in the ETFs themselves, using a similar methodology as we rank the asset classes, right? So we'll rank the stocks and in the same way. And we will then choose 10 to 20 of the highest ranked companies to be the portfolio that comprises the PAS stock strategy. That's our highest growth strategy. It's suitable for accounts in your portfolio with a longer time horizon to help facilitate meaningful asset growth, support your aspirations, transfer wealth over generations, et cetera. We have other strategies as well. For example, a tactical core that invest in broader asset classes and groups. So that uses a different asset class selection methodology as opposed to autos and semiconductors. It's going to be a more broad-based asset selection, large cap stocks, small cap, mid cap, growth, value, foreign markets, the more traditional asset classes. However, it's also actively managed using proactive indicators. We have, in addition to that, more conservative strategies that are designed to produce cash flow and be reliable, for your income needs. We have a buffer ETF strategy that's designed to help reduce the uncertainty in the stock market by taking advantage of market growth while maintaining a downside buffer. That uses a different group of funds to do that. And a proactive income strategy for producing reliable cash flow, but also seeking appreciation from underpriced market opportunities. What I'd like to do now is take this opportunity to put another poll up. We'll put the second opinion service offer up. So, after having viewed this webinar, if you're unsure if your strategies or the advice you're receiving are appropriate for the market and economic political environment that we're in, we will offer you a complimentary second opinion on your finances. And if you would like to take advantage of that, just fill out the survey. Let us know your preference. We'd appreciate feedback either way, whether you would like to take us up on that offer or not. And if you do, then what we'll do is contact you by phone for just a short discussion and establish some common ground. And then from there, we would schedule a meeting. We call it a discovery meeting that helps us get a good handle on where you are today, where you want to go. And from there, we could start to look at your investments, as well as other, wealth plans from a tax strategy, cash flow planning, et cetera, to see if they're appropriate for you to achieve your objectives. If you're being well taken care of, then we'll let you know that we're not for everybody. We can't work with everybody. We work with a select group of families where there's a good fit. And if we think that you're being well taken care of, or in your own investment approach that you're doing fine, we'll let you know that. If not, then we'll evaluate whether we're the right advisory firm to help provide you solutions. If we are, we'll discuss working with you and how that looks like, and how we could help you achieve what's important. If we don't think we're the right fit, but you could use some help, we promise to lead you in the right direction and to point you to solutions that could help you achieve success. So we're at about 1:12 here Central Time. Appreciate everybody's time. I don't know if, I'm sure some of you are retired and have some additional time. I'm happy to stay on to answer any additional questions you might have. If you have to get back to work, certainly understand that as well. But thank you for attending today's webinar. I hope that you found the information interesting and valuable.